Welcome back to the Afternoon Constitutional. Our friend Mark Smith from Red Wave Investments, redwaveinvestments.com. Take a look at what the market did today. And Mark, how were things on volatile Wall Street? We were talking a little price controls and protectionism before, but what was Wall Street all about today?
You know, Wall Street was pretty upbeat today, and it was sort of the exact opposite of yesterday. And, it's kind of interesting. Yesterday we were talking a little bit about Nike's strong earnings after the close, and it seemed like Nike, along with Tiffany's, which both reported really good earnings, kind of led the market higher today. I think people put Cypress a little bit on the back burner, even though there doesn't appear to be any resolution to that situation yet. But there was strength across all sectors, and in fact, the exact inverse yesterday. Yesterday, every sector was down. Today, every sector was up. So overall, a strong way to end a volatile week.
Now, you write in your market recap, talking about something I thought was compelling here, if you don't mind me poking around in this a little bit. Your column, which you can get from redwaveinvestments.com. The piece is entitled "Fewer Indebted, the Rest Owe More." Percentage of Americans not carrying debt of any kind increased from 26% to 31% over about a 10-year period. That's a profound thing to me to see that. What do you accredit that to? But then the sad thing is the people who do have debt have more of it. What do you kind of attribute to some of those economic drivers?
Well, I found that article really interesting as well, and the census came out with that data yesterday, and I've been trying to kind of think about what exactly it means, and the highlights that a lot of media was covering was that older Americans, 65 and older, saw the number of people that had debt doubled, or the amount of debt they had outstanding doubled, and to me, I think it's probably a little bit of, I assume that is also true, but just given how the population is shifting to an older population, I think you're probably seeing more baby boomers that are paying off their mortgages, are living debt-free, and it's a lot of these younger individuals that are continuing to run up debt. So it was kind of a double-edged sword, because on the one hand, it's great to see a third of the population not carrying any debt, but to see the remaining people, they saw a 40% increase in debt outstanding, and that's on an inflation-adjusted basis, which is a little bit alarming. It's one of those things where debt obviously fuels consumer spending, which can fuel economic growth. But as we saw in 2008, there is a point at which you cross over and it becomes a significant negative on the economy.
I hear that axiomatically put forth, but I know that credit is something that there has always been some sort of credit, but give us an idea. I truly believe that we do much more of our consumer spending on credit than any generation ever before, Mark, and certainly in recorded, recent American history. So we had economic growth before there was this much credit. Why does it seem axiomatic that in order to have economic growth, we have to have a lot of people using credit?
Well, I don't know if the second half of your statement is necessarily what people argue. I think that having extra credit, it just definitely juices economic returns. So maybe if growth would have been 2.5%, it was 3% because of people increasing their borrowing. But you raise a very good point, and clearly we've shown as a country that we can grow and we can generate significant economic prosperity without everybody using debt. And I think if you look at, if you went back, and I'm just kind of talking here, I didn't do this math today, but if you look over the last 20 or 30 years, you would see a long stretch of very positive growth, but it was not linear, right? We had a sharp run-up in the 90s and the 2000s, and then a sharp drop-off over the last 5 or 6 years, and we've kind of made some stuff back. But I think some of that is the fact that we front-loaded some economic growth through the, through the use of leverage, and that eventually had to be. But it's that fine balance between what is a healthy level of debt, and I'm not a believer in debt, but people use it, and it can work for some people, and the same way is with the U.S. government. A certain amount's fine, an excessive amount is problematic, and we're, I think, on both fronts kind of skating right at that line.
Well, is it important? And I guess the issue we saw in the housing market as well was people were saying, "Oh, good, I can get myself more house because mortgages are being kind of backed up by these subprime mortgage bundles," and so the people were saying, "Well, I want a $200,000 house." The mortgage lender was saying, "Well, I can get you qualified for $300,000, but that was more than was a sustainable amount." Is that kind of what you're talking about?
Absolutely, and actually, I just actually put something up today on my blog about buying a house and thinking about how much you should borrow to buy a house, and it is one of those things that a lot of times banks, for whatever reason, whether because they know they're going to turn around and sell it in a securitized package to someone else, or whether they just believe that you can pay back a certain amount. The amount that somebody will lend you and the amount that you should want to borrow are very different numbers, and I think part of that is just people needing to say, hey, we need to, sit down and do the math and decide what I'm comfortable paying, not just going, oh, okay, somebody told me I could pay it back, so I might as well just, borrow to the hilt,
right.
and not really thinking about the incentives on the other side.
That's the thing that I think is amazing is we seem to look at a banker or a mortgage lender who is making a commission off of selling us a product and saying, well, they know more than I do about my finances, and that's the part that changes. And that's why I love folks like my friends at Prime Lending who are much more along the lines of no, we are trying to be broken free of that mindset and do a more ethical approach to personal finance rather than just getting a commission.
Yeah, and that's a great point. And there are, sadly, there were too many mortgage brokers through the crisis that, they weren't holding the risk, and they got paid, like you said, a percentage of the mortgage, and real estate brokers get paid a percentage of the sale price, and all of that leads everyone else that you're working with to have an incentive to push you to the edge of where you can go financially. And unless you've thought about it and done the research and educated yourself, you become susceptible to just believing that if they're telling you it's possible, that it's a good idea.
Yeah, it's a dangerous precedent. And then you started to see people, and this was, I guess, the sad part, was they were taking out second mortgages or home improvement loans and then using them for non-home improvement things. So, we bear a certain amount of our own responsibility in the financial issues that we saw. But it's a heady and it's exciting story to see more people getting out of debt. Taking whether it's Dave Ramsey's rice and beans and rice approach or not, but they're getting out from that. Do you think there's hope for that other 69%?
I hope so. And the one thing that this study did not put out yesterday when it came out was the breakup by income. And I think it would be interesting to see that, because I would guess that it's not what you would think, and that there are people that are indebted all along the income scale and people that live within their means all along the income scale. But I do worry that we could end up in a situation where you have a certain percentage of the population that is thriving because they're not held back by all this debt that they've accumulated, and then 60-70% of the population that is just hamstrung by the fact that they've overborrowed and over-levered themselves.
Mark Smith, RedWaveInvestments.com. One of the things we've been kind of watching, because it sort of sets banking precedent, but it also has international financial benefits. Cyprus, the Cypriot Parliament just adopted a law giving the government powers to impose capital controls on their banks and do more controlling over them. So is this a good answer to what's going on, or is this more protectionist government intervention that started this story?
Well, I would say anytime you put in capital controls, that's a protection. I don't know if it's protectionist, but it's definitely not a free market. It's moving you away from a free market economy. And if you look at Cyprus, and they have roughly 50% of all their bank deposits are foreign, and largely Russian, but many other foreign entities or individuals. And I'm sure that they're thinking, I'm sure those people are thinking, as soon as these banks open, and remember, they were supposed to open yesterday, and now they're saying they're going to open on Tuesday, so who knows when they're actually going to open. I'm assuming most of those people are thinking, the day they open, I'm taking my money somewhere else. So, this is an attempt to prevent a massive bank run. But long story short, eventually it's not going to end well, right? You can put some controls in, but you're not going to save yourself with capital controls.
Well, and that's the part that I think is interesting, is that they're trying to. I don't know if more capital controls, are in the offing for more of these European Union countries. But I think what they're dodging is the responsibility of the fact that that their control of the marketplace and their manipulations of it actually caused this, Mark.
Oh yeah, well, I think we've seen in both our own U.S. problems and Europe problems that governments rarely like to admit that they make mistakes. And Cyprus decided that it was going to become like an international tax haven, and they attracted all kinds of foreign money, and then they used those deposits to fund investments in very risky sovereign European debt, and that went bad. And so now they're trying to cover up their mistakes by locking capital in place and not allowing people to withdraw it. And again, maybe that saves them for a couple of weeks, but that doesn't solve the problem by any means, because either the entire value of their banking sector, which was a lower tax and easier economy to work with, is now destroyed, or eventually people pull the money out and that causes the bank run, which causes the collapse of the banking sector.
I'm mature enough to understand that there isn't a finite amount of capital in the world, and you can create more by your labors and all. But I mean, as you watch more and more of these governments who are going bankrupt because they've lost money places, you start to wonder, well, some of that money had to go someplace. They didn't burn it in a pile, even though their economic policy might look like a bonfire. They didn't physically burn this money, this treasure in a pile. So I mean, why are we only seeing the poor countries off of this, and we're not seeing the places where this money wound up going?
Well, I think you have a couple of things. So when you see these banking, when you see a bank collapse, right? So a bank will take deposits, and they only have to generally hold, call it 8% capital against whatever deposits, right? So they will take 92 cents and go lend that out to all different kinds of people, right? So in Cyprus's case, they lent a lot to Greece, or through either directly when they issued the debt or buying it in the secondary market. And then if those assets go to zero, the value goes to zero, all of a sudden they don't have the capital necessary to be able to redeem bank deposits and various other things. And so, it could be that a lot of this money, and Europe was notorious for encouraging banks to buy sovereign debt. I mean, they pushed and gave them every kind of financial incentive to do that, and so the money went to wherever these government spending went. It's somewhere, but
so it's not one person. It's a bunch of employees and smaller businesses that were paid for services in things that didn't wind up turning out into anything fruitful. But there was wealth or income earned based on this expenditure.
Absolutely.
Yeah, so. Well, Mark, thank you for your insight. Again, you can find Mark's stuff up at redwaveinvestments.com. Subscribe to his newsletter. Get stuff like this, these stories in your inbox. And you can email him at mark, M-A-R-C, at redwaveinvestments.com. Have a great weekend, my friend.
Thanks. You too, Joe.
And